The American banking system is flashing warning signs. These signals are not to be taken lightly as they could indicate deeper issues within the financial sector. Data reveals a concerning trend, a widening gap between loans and deposits. This gap suggests that banks are lending out more money than they are taking in from deposits, which can be a risky strategy. This imbalance, coupled with the aftereffects of the Federal Reserve's pandemic-era policies, has experts worried. The policies initially designed to stimulate the economy may now be contributing to financial instability. The situation echoes the vulnerabilities that led to the 2008 financial crisis. Back then, unchecked lending practices and insufficient regulatory oversight resulted in a catastrophic collapse. While a full-blown crisis is not guaranteed, understanding these red flags is crucial for investors and everyday Americans alike. Being informed can help individuals make better financial decisions and prepare for potential economic downturns. The health of a bank's loan portfolio is paramount. A strong portfolio indicates that the bank has made prudent lending decisions, while a weak one can signal trouble. When loans sour, banks face losses. These losses can quickly add up, affecting the bank's overall financial health and its ability to lend in the future. These losses can erode capital and, in extreme cases, threaten a bank's solvency. If a bank becomes insolvent, it may be unable to meet its obligations, leading to a loss of confidence among depositors and investors. The current environment, marked by rising interest rates and economic uncertainty, increases the risk of loan defaults. Higher interest rates make borrowing more expensive, which constrain both businesses and consumers. This makes understanding the loan-to-deposit ratio more critical than ever. A healthy ratio indicates a balanced approach to lending and deposit taking, while an unhealthy ratio can be a red flag for potential financial trouble. Investors should keep a close eye on these indicators to make informed decisions. By staying vigilant, they can better navigate the complexities of the financial landscape. Community banks in particular play a vital role in local economies. Their stability is crucial for the financial well-being of the communities they serve. As the situation unfolds, staying informed through reliable financial news sources is essential. Knowledge is power, and in times of financial uncertainty, it can make all the difference. Financial literacy and education are more important than ever. Understanding the basics of banking and finance can empower individuals to make sound financial choices. While the challenges are significant, there is hope. With the right measures and informed decision-making, the American banking system can navigate these troubled waters and emerge stronger. The loan-to-deposit ratio is a simple but powerful metric. It measures the proportion of a bank's deposits that are lent out. A high ratio suggests that a bank is aggressively lending, which can be profitable but also risky. A low ratio suggests a more conservative approach with less profit potential but also less risk. Historically, a loan-to-deposit ratio above 100% has been a cause for concern. It indicates that a bank is funding loans with more than just deposits, potentially relying on riskier sources of funding. In the current environment, even ratios below 100% warrant scrutiny, given the overall increase in risk. Recent data from major U.S. banks paints a concerning picture. Several institutions are showing significant imbalances between loans and deposits. For example, Bank of America's loan-to-deposit ratio has been steadily climbing, exceeding pre-pandemic levels. Similarly, JPMorgan Chase, the nation's largest bank, has seen its ratio rise significantly. This trend is not limited to the biggest banks. Regional banks are also feeling the pressure. Many are grappling with deposit outflows as customers seek higher yields elsewhere. This further exacerbates the loan-to-deposit imbalance, making these banks particularly vulnerable. The current situation in the U.S. banking sector has drawn comparisons to the period preceding the 2008 financial crisis. Like then, banks are facing liquidity challenges and concerns about asset quality. The rapid rise in interest rates, reminiscent of the period leading up to the Lehman Brothers collapse, adds to the anxiety. However, there are also key differences. Banks today are generally better capitalized than they were in 2008, thanks to stricter regulations implemented after the crisis. Additionally, the Federal Reserve has more experience and tools at its disposal to intervene in the event of a liquidity crisis. The Federal Reserve's role a double-edged sword? The Federal Reserve's actions have played a significant role in the current situation. During the pandemic, the Fed injected trillions of dollars into the financial system, leading to a surge in bank deposits. This excess liquidity, coupled with historically low interest rates, fueled a lending boom. However, the Fed's aggressive monetary policy also contributed to inflationary pressures. To combat inflation, the Fed has been raising interest rates aggressively, which makes it more expensive for banks to borrow money. This puts further strain on their loan-to-deposit ratios and increases the risk of a credit crunch. Inflationary pressures, a looming threat. As we navigate through these turbulent economic times, the specter of inflation looms large over everyday life. From skyrocketing grocery prices to the rising cost of essential goods, the impact is felt by everyone. Families are finding it increasingly difficult to make ends meet, and the anxiety is palpable. The link between the banking sector's troubles and inflation is complex. Financial analysts are working tirelessly to decode the data, trying to understand the intricate relationship between these two critical aspects of the economy. Economists are in heated discussions, debating the potential outcomes of the current financial crisis and its long-term effects on inflation. On the one hand, a credit crunch, where banks reduce lending due to liquidity concerns, could help to cool the economy and curb inflation. This reduction in lending means less money circulating in the economy, which can lead to a decrease in consumer spending and investment. However, this also means that businesses may struggle to get the loans they need to grow, potentially leading to higher unemployment rates. On the other hand, banks facing losses might be more inclined to raise interest rates on loans, further fueling inflation. Higher interest rates can make borrowing more expensive for consumers and businesses alike, leading to increased costs that are often passed on to consumers in the form of higher prices. This can create a vicious cycle where inflation continues to rise, making it even harder for people to afford basic necessities. The Federal Reserve faces a delicate balancing act. As the central bank of the United States, it has the challenging task of managing monetary policy to control inflation while also ensuring the stability of the financial system. The decisions made by the Federal Reserve can have far-reaching consequences, affecting not just the national economy, but also global financial markets. It must tame inflation without triggering a financial crisis. This requires a careful and measured approach, as any misstep could lead to severe economic repercussions. The Federal Reserve must weigh the risks and benefits of its actions, considering both short-term and long-term impacts on the economy. The central bank's ability to achieve a soft landing, bringing down inflation without causing a recession, will depend in part on the resilience of the banking sector. A strong and stable banking system is crucial for maintaining economic stability and ensuring that the Federal Reserve's policies are effective. Economists are hopeful that with the right strategies, it is possible to navigate these challenging times and emerge with a more robust and resilient economy. Navigating the storm potential bank actions. Banks are not passive players in this unfolding drama. They have options to address their loan-to-deposit imbalances. One option is to slow down lending, which would reduce the need for deposits but could also stifle economic growth. Another option is to attract more deposits by offering higher interest rates, which would cut into profits. Banks could also sell assets such as securities to raise cash. However, selling assets in a down market could lead to losses. Ultimately, the choices banks make in the coming months will have a significant impact on their own financial health and the broader economy. The broader economic impact, a ripple effect. The health of the banking sector is inextricably linked to the health of the economy as a whole. A banking crisis would have severe consequences for businesses, consumers, and the global financial system. Even without a full-blown crisis, a slowdown in bank lending could lead to reduced investment, job losses, and slower economic growth. The current situation underscores the importance of a robust and well-regulated banking system. It also highlights the need for policymakers to be vigilant in monitoring risks and taking appropriate steps to mitigate them. In these uncertain times, it is more important than ever to remain vigilant and aware of the financial landscape around us. The warning signs in the U.S. banking sector are real and should not be ignored. From fluctuating interest rates to the instability of certain financial institutions, the indicators are there for those who are paying attention. While a repeat of the 2008 financial crisis is not inevitable, the potential for a severe downturn is real. The echoes of past financial turmoil serve as a stark reminder of what can happen when vigilance is not maintained. Understanding the risks and vulnerabilities in the system is crucial for investors, policymakers, and the public alike. Vigilance is key. Monitoring bank earnings reports, tracking key economic indicators, and analyzing market trends are essential practices. Staying informed about policy developments can help individuals and institutions navigate this challenging environment. Regularly reviewing financial news, attending economic briefings, and consulting with financial advisors can provide valuable insights. The road ahead may be bumpy, with unexpected twists and turns. Economic forecasts may change and market conditions can shift rapidly. But with careful attention and proactive measures, we can mitigate the risks and work towards a more stable and resilient financial system. By fostering a culture of awareness and preparedness, we can build a foundation that withstands economic uncertainties and promotes long-term prosperity for all.